Welcome to the Deep Dive. We're jumping into the latest from Black Rifle Coffee Company, specifically their Q1 2025 earnings discussion.
That's right. Our mission here is to pull out the key insights, figure out what's really driving things for them based on what they shared.
Exactly, helping you understand the numbers and the strategy behind them.
So let's get started.
Okay, high level first. The reported numbers for Q1. Total revenue was down 9% year over year. Gross margin took a hit, 36% of sales, which is down about 680 basis points from last year. That's pretty chunky.
It is. And adjusted EBITDA came in around $1 million, also down compared to Q1 last year.
So yeah, on the surface, those reported figures look, a bit rough.
They do, but, and this is really crucial right off the bat, you absolutely have to consider the context from Q1 2024.
Oh, okay. What was going on last year?
There were some significant non-recurring items. Specifically, $8.5 million in revenue from barter deals and a $3.4 million benefit from a change in how they booked loyalty rewards. Those things inflated last year's numbers.
Right, so those aren't repeating this year. That obviously makes the year-over-year comparison look worse than the underlying business might be.
Precisely. So if you strip those one-off items out from last year's Q1 to get a cleaner sort of underlying comparison.
What does the picture look like then?
Underlying total revenue is actually up 4% year over year.
Okay, see, that's a totally different story. From down 9% reported to up 4% underlying, that's significant.
It really changes the narrative, doesn't it? It shows the core business is still growing despite those items cycling out.
Definitely. So how did that 4% underlying growth break down? Let's look at the segments. Wholesale.
Right, wholesale. Reported revenue there was down 6%. But again, adjust for that $8.5 million non-recurring barter revenue from Q1 24.
Yep.
And underlying wholesale revenue grew by a solid 9%.
9% underlying growth in wholesale. That's strong. What's driving that?
It's mostly about distribution. Getting into new stores, getting more shelf space than existing ones. They mentioned sales into food, drug, and mass retailers, FDM, grocery stores, drugstores, big box places.
Right.
Excluding their single biggest customer, sales to all other FDM retailers actually quadrupled, 4 times growth.
Wow, quadrupled. Okay, that shows real momentum in broadening their reach.
Yeah.
What about that largest customer?
Even sales to their biggest retail partner grew 3%. So growth across the board there, but especially strong expansion with newer partners.
And how's that translating into overall availability? They track ACV, right? All commodity volume.
They do. Their overall ACV across tracked channels jumped 12 points to hit 50%. And specifically in grocery, they reached 45% ACV.
Half the track market, almost half of grocery. That's good progress. And how's their coffee actually selling in those stores?
That's another interesting point. Within those US FDM channels, their coffee sales grew 21% in Q1.
21%. How does that stack up against the overall coffee category?
The total coffee category in those channels only grew 4%. So BRCC is massively outperforming the market.
And they achieved that 21% growth without taking price increases themselves during Q1, right?
Exactly. Management pointed out that the category's 4% growth was mostly due to competitors raising prices. Meanwhile, BRCC's unit volume, the actual number of bags and cans sold, was up 34% across the market in Q1.
Up 34% on units, while the market volume was probably flat or down. That really suggests consumers are actively choosing BRCC.
It strongly implies that, people are seeking it out as it becomes more available, even before BRCC adjusted their own shelf prices later on.
Okay, so wholesale is definitely a bright spot on an underlying basis. What about the direct-to-consumer side, DTC?
DTC revenue was down 15% as reported. If you adjust for that loyalty accounting change benefit from last year, it was down about 5%.
Yeah, the reason for that decline.
Couple of things they cited. One, as products get easier to find in stores, some people naturally just buy it there instead of online. Makes sense.
Convenience.
And two, it's partly a conscious choice. They've been shifting resources, like marketing dollars, away from DTC and towards fueling that big wholesale growth opportunity we just talked about.
Okay, strategically prioritizing wholesale makes sense given the momentum. But DTC, especially the subscription part, is still important, isn't it?
Oh, absolutely. It's still core, consistent revenue, good margins. They have over 180,000 active subscribers, generating 2/3 of the DTC revenue.
So are they just letting it decline?
No, they're optimizing it. They mentioned recent upgrades to the website and app, streamlining the sign-up process, like the military discount verification. These things have apparently improved conversion rates.
Making it work better with less spend.
Exactly. They said they're seeing signs the subscription business is stabilizing, even with less marketing push behind it. Efficiency is the game there now.
Got it. Optimize DTC, push hard on wholesale. What about the outposts, the physical stores?
That segment saw a small revenue increase, about 2%, driven mainly by growth in franchise revenue and also getting customers to spend a bit more per visit through things like bundling offers and merchandising.
Okay, that covers the top line pretty well.
Yeah.
Let's circle back to that gross margin drop. 680 basis points is a lot. What were the main drags there?
Yeah, several big factors. The largest single impact was increased investment in trade promotions and pricing. That accounted for about 500 basis points of the decline.
500 basis points just from trade and pricing. Why so much?
Mostly supporting two things: the big launch of their new Black Rifle energy drink and running promotions in grocery to get people to try their coffee now that it's in more places. Investment spending, essentially.
Okay, investing for growth, new products, new distribution. What else hit the margin?
Green coffee inflation was a major one, about 330 basis points impact. Arabica prices have shot up,
Right, and they had to buy more because their volume was up.
Yeah, exactly. Higher volume meant they likely had to buy more coffee at the current high spot market prices beyond what they might have hedged earlier.
Makes sense. And that loyalty accrual change from last year.
That comparison effect accounted for another 200 basis points of the year-over-year decline. So you've got trade spend, input cost inflation, and a prior year accounting comparison all weighing things down.
That's quite a stack of headwinds. Were there any offsets? Anything helping margins?
Yes, definitely. They managed to offset some of it. Productivity gains within their operations and a favorable product mix selling more higher margin stuff together contributed almost 400 basis points of benefit.
Okay, so internal improvements helped cushion the blow somewhat.
They did. It shows they are working on controlling what they can control internally.
Which leads us back to that adjusted EBITDA figure, around $1 million. How does that fit into the bigger picture for the quarter?
Well, the company basically said they expected limited EBITDA in the first half of the year. Q1 reflects that. It's the impact of cycling out that non-recurring revenue, the timing of those big upfront investments in trade and marketing for the launches, and the plan for revenue and profit to build through the year.
So Q1 was expected to be low, with improvement coming later.
That's the expectation. They also highlighted cost-cutting work over the last 18 months, things like headcount reductions leading to an 11% drop in salary costs and a 23% fall in G&A expenses. Those savings are helping support the bottom line, even with the margin pressures.
Right. Those savings provide some foundation. Okay, that paints a much clearer financial picture for Q1. Let's talk about operations and growth initiatives. What are they focused on?
Big theme was building a stronger foundation, streamlining, investing in infrastructure, becoming more agile. Standard stuff, but important.
And specific product wins. Ready-to-drink coffee, the RTD cans, how are those doing?
Still performing really well. RTD coffee revenue grew 7% in Q1.
Okay, 7% growth.
But what's really notable is that the overall RTD coffee category in the U.S. declined by 6% in the same period.
Whoa. So they grew 7% in a category that shrank 6%. That's significant market share gain.
Huge gain. They held on to their spot as the number 3 RTD coffee brand nationally, even though they're only in about half the potential stores.
Yeah.
Lots of runway left, just filling out distribution for RTD coffee.
Definitely a sign of brand strength there. Now, the big new thing, Black Rifle Energy. Launched in January. How's that going?
Early signs are encouraging, they said. By the end of Q1, it was in nearly 12,000 retail locations.
12,000 doors already.
Yeah, reaching 21% ACV in tracked channels. So a decent start on distribution.
And how are they getting it out there so quickly?
The partnership with Keurig Dr Pepper, KDP, is absolutely key. That gives them access to KDP's national direct store delivery network.
The DSD network, that's huge for beverages, isn't it?
Massive. It means KDP trucks are delivering directly to potentially 180,000 individual stores handling the stocking. That's a huge advantage for scaling a new drink like energy.
So they have the network. How are they rolling it out? All at once?
No, they're being disciplined. Focusing on 12 priority markets for now over the next couple of years, really concentrating their efforts there first.
And focusing marketing where?
Especially in the convenience channel, C stores. They specifically mentioned getting into those hard-to-track, up and down the street independent stores, which are critical for energy drink sales.
This makes sense. Why energy drinks, though? It's a massive market, sure, but notoriously competitive.
They pointed to their customer data. Apparently, 58% of their coffee buyers also buy energy drinks. And a good chunk of their media audience only drinks energy drinks.
So a natural audience overlap.
Exactly. They see it as a logical extension for their brand and a way to tap into that huge $20 billion plus market, even with the competition. It's a long-term growth play.
Okay, that rationale makes sense. And they haven't forgotten their core mission, have they?
No, they made sure to reiterate that. Supporting military and first responders through donations is fundamental to who they are, not just, a side thing. They see it driving loyalty.
Right. Okay, let's look ahead. What's the outlook for the full year 2025? Guidance.
They kept their full year revenue guidance the same, $395 million to $425 million.
Okay.
And the plan remains that Q1 was the low point for revenue, with growth building sequentially each quarter, driven by those ongoing distribution gains for coffee and energy, plus the marketing investments kicking in.
And we need to remember that comparison issue with last year's non-recurring revenue continues for a bit.
Yeah, that's still a factor in Q2. There was $11.8 million that cycled out in Q1 and another $5.8 million impact expected in Q2 out of about $30 million total for the full year 2024 that won't repeat.
Got it. Beyond that, what about external challenges, macro headwinds?
They specifically called out tariffs as something new that wasn't factored into their previous guidance.
Tariffs.
On imports. About a third of their cost of goods sold is imported green coffee, extracts, packaging, even apparel and merchandise. They estimate tariffs could potentially hit EBITDA by around $5 million this year under the current rules.
Okay, so a new cost pressure to manage.
Yeah, they said they're working on supply chain productivity to try and offset that.
And the other big pressure? Green coffee inflation. Still a major factor.
Absolutely. Still a huge factor. Prices for their type of coffee have more than doubled since early 2024.
Wow. Have they taken pricing action?
They recently did, yes, put through a price increase similar to what competitors have done. They expect this will give a modest lift to revenue in the second half, partly offsetting that inflation.
Are they worried about consumers pushing back on price?
They seem less concerned than maybe some other brands. They mention low elasticity in their super premium segment, meaning their customers are generally less sensitive to price changes. But they're still mindful of staying competitive on the shelf.
Okay, so with tariffs now in the mix and continued coffee inflation, how did that impact the full-year gross margin outlook?
They did revise it down slightly. The new range is 35% to 37%, down from 37% to 39% previously.
And the drivers for that revision?
Compared to last year, they're now expecting over 300 basis points of negative impact from coffee inflation, even after their price increase. Another 250 basis points hit from trade investment for energy and normal promotions, and over 100 basis points impact from tariffs, mostly in the second half.
But still expecting some offsets.
Yes, still expecting over 200 basis points of help from productivity and product mix. They also guided specifically for Q2 margin to be maybe 1 or 2 points lower than Q1's 36% before improving sequentially in the second half.
So more pressure near term than improvement later. Yet despite the margin revision and these headwinds, they maintained the full year adjusted EBITDA guidance.
I did. Still guiding to $20 million to $30 million for the year.
How are they squaring that?
It really leans on those operating expense cuts they've already made, plus the expected supply chain productivity gains. And again, the plan hinges on limited EBITDA in the first half, with a significant step up in the second half as revenue grows and those pricing and cost initiatives fully take effect.
Okay. One thing that really jumped out from the call, for me anyway, was their commentary on coffee hedging. Seemed quite positive.
It really did. It sounds like a potential key advantage right now. They stated they are about 95% hedged for their 2025 green coffee needs.
95% locked in for the year. At what kind of price increase?
Their average hedged price is up about 40% compared to last year. Now, 40% sounds like a lot.
But compared to what others might be facing.
Exactly. They contrasted their position with competitors, who they estimate are maybe only hedged 90 days out and could be facing coffee cost increases of over 100% year over year.
Wow. So being 95% hedged at plus 40% versus potentially being unhedged and facing plus 100%, that's a massive difference in cost structure for most of the year.
It seems like a very significant potential cost advantage relative to peers for 2025. They're even looking at 2026 hedging already.
That hedging position feels really crucial given the inflation.
Yeah.
Did they say anything about the broader economy? Potential slowdown?
Yeah, they touched on that, said historically when the economy slows, people might cut back on expensive coffee shop visits but drink more coffee at home.
Which could benefit premium grocery brands like them.
That's the idea. It tends to help super premium brands selling in retail. They pointed to overall coffee category unit stability despite price hikes, and again highlighted their own strong 34% unit growth in Q1 as a sign their demand is holding up well.
Okay, so pulling it all together, it's a complex picture, isn't it? Navigating these headwinds, cycling tough comps, but showing underlying growth, pushing hard on energy, benefiting from cost cuts, and that crucial hedging position.
Definitely. The strategy seems clear. Invest heavily now, especially in wholesale and energy, absorb some near-term pain on margins, but leverage distribution, cost control, pricing, and that hedging advantage to drive a much stronger second half and hit those full-year targets.
Right. Which brings us nicely to our This Is Not Financial Advice segment. Based only on the information from this earnings call, we've got an outrageous but plausible trade idea for you to ponder. Remember, purely illustrative.
Just an idea sparked by the call details, definitely not a recommendation. How about this? Consider a potential pair trade. Go long BRCC stock and simultaneously short a publicly traded competitor.
Oh yeah, pair trade. Long BRCC, short a competitor. What's the rationale based only on the call?
Two main points jump out from our discussion. First, that green coffee hedging situation. BRCC explicitly stated they're 95% hedged for 2025 at a 40% cost increase. They contrasted this with competitors potentially only being 90 days out and facing maybe over 100% increases. If true, that's a potentially massive relative cost advantage for BRCC this year.
Okay, point one is the hedge advantage. What's point two?
Point two is the growth catalyst from the new energy drink. They have a focused launch strategy targeting specific markets and channels, crucially leveraging that national KDP DSD network. This gives them a powerful distribution engine for a major new product category. A competitor might lack that kind of focused new product momentum or a comparable distribution asset right now.
So, relative cost advantage plus a unique growth catalyst. Why is it outrageous but plausible?
Well, it's outrageous because pair trades are risky, markets are volatile, and we don't actually know the full details of competitor situations. We only have BRCC's perspective from the call.
Right. High risk, incomplete info.
But it's plausible because the logic flows directly from specific concrete points BRCC management made about their relative strengths hedging, ADP network, energy launch focus, versus the implied challenges or lack of similar catalysts for others based on that same call information. It connects the dots presented in the discussion.
Got it. Again, just an illustrative idea derived from the call content, not financial advice. So let's recap the key takeaways from this deep dive.
Okay. Black Rifle Coffee's Q1 reported numbers were heavily impacted by prior year non-recurring items, cycling out, masking underlying growth.
That underlying growth was solid, especially in wholesale, driven by big distribution gains where they're significantly outperforming the coffee category.
They're investing heavily right now, particularly behind the new energy drink launch using that KDP network, which is hitting near-term margins along with coffee inflation and new tariff pressures.
However, they seem to have a strong coffee hedging position for 2025 compared to peers. They're realizing benefits from past cost cuts, and they maintained full-year guidance.
Yeah, the whole story really points to an expectation of much stronger performance and profitability in the second half of the year as investments pay off and tailwinds like pricing and productivity kick in.
Which leaves us with a final provocative thought for you, the listener, to chew on. Considering all these moving parts, the upfront spending, the macro pressures, but also the strategic initiatives,
how effectively will BRCC's specific game plan that targeted energy launch using KDP in key convenience markets, combined with their coffee hedge advantage and internal savings, actually allow them to hit that maintained guidance and deliver meaningful bottom line improvement in the back half of this year and looking forward?
Something to watch closely. That's it for this deep dive. Thanks for tuning in.